deal. This is how to buy $1 million business, unlock your path to business ownership, generational wealth, 7 steps to acquiring $1 million business with 100% outside funding. Now, this is going to be the first 3 steps to do this because that's the biggest part of this is the first 3 steps. So the reason I put this chart up here is just giving you an example. If you go find a company doing a purchase price, 1.8 million, with a net income, 600,000, it could be doing 3 million top line, but let's say it's net income is 600,000, purchase multiple 3x, very standard for a small business. The buyer equity invested, and you can either bring $300,000 or with the benefits of the new SBA program and outside investors on social media, you can get 100% funded from outside investors. Keep 16%. You still get a loan, let's say, from SBA, and that's 76%. So it's 1.2 million. Annual payments, 206,000. That's your debt payments. Your net income is going to be $394,000. So just on $300,000 invested, you now own a business worth $1.8 million, and your first year ROI is 33%. That is a fantastic investment, just to let you know. So how do we do that? All right. First, I want to introduce myself. If you don't know me by now, I'm the guy with the podcast. I've done 130 interviews with serial acquirers. I have got great teachers, just let's say. 100 people have actually bought my business course and my LinkedIn course and a bunch of other courses. Some buy the just deal review course. Some just buy the business buying course. I've actually done 3 acquisitions myself. And I'll be honest with you, not all of them work out. One of them I bought and actually had to shut down after 6 months. One of them I built up and sold it on Empire Flippers. And I talk about that on an episode with the CEO of Empire Flippers. One of them I still own shares in, which aren't worth very much because it's an OTC company. So this is all about learning, and I'm working on my 4th acquisition that I will talk about in this episode. I told you, I've done Top M&A Entrepreneurs Podcast and creator of Deal Flow System. So let's go to the next page. So just December 31st, one of my students, Top Diamond, purchased a security company. And I just wanted to show you what we did. And he was kind of like a test subject for me because I just started this business buying journey, not buying businesses, but the helping other people buy businesses about a year ago. And he came to me about 6 months in, and I basically outlined exactly what I did. And he applied it, and he acquired a security company on December 28th, 2023. And I'm going to show you a little bit more about that. But before I jump into that, I just wanted to let you know, he didn't use me alone. He had a deal team. He had Kevin Henderson from SMB Law Group, who I introduced Tom to. August Felker was his friend, but an accountant, did the accounting. He had Ryan Kroge, who was his SBA lender. The reason he brought in Ryan Kroge was Tom Diamond was actually a dual citizen, Canadian, United States. And Ryan did a lot of businesses that happened to do with former Canadians. So Ryan was Canadian himself. And Patrick Stroth, who does insurance. So he wrote the policies for him, and he wrote Rep's insurance policy. So you can see the deal team there. You've got the law, got the accounting, and you got the insurance, and then you got the SBA lender. So before we took this deal, we had to make sure it was a good deal before we took it to these folks here. All right, so this is a pictorial of where you're at right now. You're the person on the bottom, and you've got this big mountain to climb, and you need to be prepared to do this. And I'm going to give you the 3. I separated it into 3 different areas where you need to do it, because I'm not going to talk about the 4 things that happen on the bottom on your way down because you already have momentum. I'm talking about the 3 things that are going to help you get to the top. So let's get to those. The first one, and let me set this aside. Like, you're already ambitious. You already have desire to buy a business. You already want it badly. These are the things that I can help you with. Number 1 is deal flow. And there is on-market deal flow and off-market deal flow. And you can look at this right here. You're going to have to set your expectations and do 1,000 outreach. And do this. Just set your calendar, write it down, say, I don't care. To get to the 3 to 5 deals, I'm going to do 1,000 outreaches, 600 responses, hundreds of conversations, possibly 20 offers to get to 3 to 5 deals. It's a number game. That's not exact, but I'm going to show you what that is. And that includes on market, which is going to all the business brokers online, whether it's local or United States or worldwide. Those are on market deals. Or it's off market, meaning you're writing letters to people, you're planting seeds with your service providers, like your accountant. You're talking to them going, hey, if you know any businesses that are trying to sell, let me know. I'd be interested in buying. Or you're talking to lawyers doing the same thing. You're talking to people at Chamber of Commerce doing the same thing. That's off market, going direct, planting seeds. On market is a little bit different because the brokers are doing all the legwork for you, right? They're going to find a business, they're getting a multiple, and they're getting a motivated seller. That happens a lot faster than the off-market deals. So set your expectations, but combine them together, you're going to be doing outreach. Set your expectations because it's a numbers game. All right, so let's look at this Tom Diamond, what we did. He looked at close to 250 plus minus deals. Those are SIMs. He saw them on Biz Buy Sell. He used with Kumo. He looked locally, and he got all these SIMs. And we reviewed them all. And I said, like, Tom, we looked at 11, got the financial report cards on 11 businesses. And when he found this one business that he purchased, I said, man, this is a green light. Make an offer on it. The company had $2 million in revenue, $700K in net. I mean, everybody's done this long enough, so that's a pretty good margin right there. Tom offered $2.5 million. So I don't know why this bottom line didn't show up. That's the first problem with using Canva. I don't know if everybody's used Canva before. So it says accepted, December 28th. All right. Oh, there it is right there. Showed up. So finding deals. That's the first thing. Second thing is deal review. Deal review is being able to knowing what good deals are, which means good deals that are financeable. Your job is to buy cash flow at a fair price. And only good deals are financeable. But to sift through a bunch of 250 deals, you have to identify bad deals in 5 minutes or less and then get rid of them. So, and the only way to do that is become more skilled at identifying or understanding what the language of business is, which is accounting. Now, I don't know how many people out there are accountants. You don't have to be. You just have to know what an income statement looks like, a good one, what a bad one looks like, a balance sheet, good and bad, and a cash flow statement. Is anybody an accountant here, or advanced accounting degrees? Just like put it in the chat, just go yes or no. So let's take a look at what a bad deal is first, because this is going to invariably happen. You're going to have to sift through hundreds of these to be able to find a good deal. So this just came in. I got a student here in Tucson. He's trying to buy a business. He saw this at a Scottsdale business broker. And here's the sim. I mean, look at that right there. It says 2023 gross sales, $4 million. EBITDA is 1.5. That's 4 car washes in Tucson. They don't look like great car washes. They're not the brand new ones, but it says it's doing $1.5 million. So you go, yeah, let's look into it. Let's get the financial report cards. And we did. Look at this. This is it right here. Blue Car Wash, combined, 4 locations, losing $270,000. This is a bad deal. The point of understanding these cash flow statements real fast is going, there's no way I can finance this deal. There's no way I can fix it. I can't do anything. It's a bunch of real estate. It probably means just tear it down and start over, because I couldn't even afford the real estate with the cash flow thrown off. Identify bad deals, 5 minutes or less, and move on. Let's go back to this and look at a good deal. What's a good deal to look at? This is a business I am looking at right now. It's a plumbing business in the Southwest, and you could see the top line income is $14,818,624. Wow, big number, right? Bottom line, this is through September, so we got 3 more months, right? October, November, December. It's doing 2.8. So it should hit like $3.5 million, it looks like, based upon this. So 20% net income on a plumbing company. And they already happen to have a GM in place, and the owner just is absentee. He only spends like 5-10 hours a month in the office. Would you say this is a good deal at the start? Yes or no? All right, so it's 2.9, probably going to be doing 3.4 end of the year, which is fantastic. And it's been around for 20 years. So the next thing is we want to look at the balance sheet. The balance sheet is how they turn their assets into cash flow. And if the net income on the balance sheet, 2.968, matches the net income on the income statement, 2.968, that tells me the books are balanced, right? That's a good sign that, there's a little bit more confidence in the financial report cards. You can also see that he's got $3.4 million in cash. Fantastic. You could see the liabilities here. Total current liabilities are $286,000. This business is a great business. In fact, we are placing an offer on it this week. This is what it looks like. What I'm trying to show you is like, hey, bad deals, delete them fast so you can focus on good deals. This is probably the 500 deal we've looked in the last 6 months, and it's just sifting through this. I can tell this right now that they're using accrual basis. That's at top. That's supposed to be. If it's cash accounting, usually they put it in an Excel spreadsheet and kind of make up the numbers. They're manipulatable. I could tell that they use QuickBooks. They use a software. And I could tell that the books are balanced because the net income on the balance sheet matches the net income on the income statement. The only thing I don't have is the cash flow statement. So the opening cash on the cash flow statement should match the cash and the total cash in the bank, given the same time period. Yeah. I mean, it doesn't have a lot of debt, not a lot of heavy assets. I mean, it does have assets, but we're not bogged down by that. It's a nice looking business, and we're going to make an offer on it. Really important is if you're going out and you're going to borrow money on this, is that your DSCR, or debt service coverage ratio, is at least 1.5 or greater. That's all financial institutions are going to look for, right? Can you pay back your cash? So if you borrow $10, you need to be earning $15. Anything better than 2.0 is fantastic. So that's always what you're going to go into when you're looking to finance a deal. Let me give you an example of right here at the bottom, I use SBA.7a. You can copy this in there. But I always check to see what the annual loan payments would be on an SBA loan. Now, if I put $1 million in there, I say 12%, but right now it's 11.25. I add more because of the closing cost over 10 years. And I know my annual payments will be 172. Now, the business I'm going to put an offer on is not SBA eligible because it's too big, unless I buy just partial 51% of it. We may do that, may not. We'll have to keep going. I'm telling you, I just came across this deal last week, and we're moving fast on it. So use this loan calculator to see if you can get the debt service coverage ratio correctly. All right. The third part is deal financing. Now, there is really only two ways you're going to be able to buy a business, and that's through debt and equity. And once you see that, they're using accrual accounting, they're using a financial software package, they're making money, there's not a lot of debt, and the books are balanced, and you go, man, this is a good deal, and that it's financeable. You run your numbers. You're going to send them an LOI, and you got 90 days to raise this capital. So you're either going to go to SBA or some debt lender, or you're going to put up equity. And every time you go out and look for a business, it's kind of going to be different in the structure on this. It's unlike real estate with businesses. Real estate is completely different when you're structuring a package together. Let me give you an example of this. These guys in this business are asking for $12.5 million. So, all right, I'm going to ask you guys to do a little math. They're going to do $3.4 million. They're on target for that. What is the multiple on this business if they're asking 12? Do you think that is a fair price on a business throwing off $14 million and 3.4 net income? Yeah, he's retired. He's done. He's out. He just wants to move it fast. We got to work backwards and see how much debt can this business manage to keep at least minimum 1.5 debt service coverage rate. You can just work backwards. Like, hey, if my net income is 3.4 and my debt service coverage ratio is 1.5, what are my debt payments on that, and what's the cash flow need to be? So that's easy to do. Are you suspicious if any deal is marked under 3x multiple? No, not really. It depends on the business. I mean, you got to look at, how long the business has been there, how many customers it has, what's their profit margin, what kind of business do they do? This is an interesting question. I had somebody on LinkedIn reach out to me and try to sell a course business. They teach day trading, and they're only offering 3x on it. And it's throwing off almost 50% margins. And I go, am I suspicious of that? Yeah. First of all, it's a get rich quick scheme, right? Day trading at any point, algorithms are going to do all of that for you. And two, they're advertising on Facebook. I'm not an expert on Facebook advertising, but I could tell you that Facebook hates the get rich, invest ads all the time. I know that for a fact. I try to run it, but I'm not in Facebook advertising. And I saw this on Flippa, and they can't sell it at 3x. He reduced the price from 3.5 to 3x. So am I suspicious? No, yes and no, but it requires further due diligence. All right, thanks for the question, Nick. So anyway, this is a plumbing company, Southwest. We're looking at it. They have $65 million in their pipeline.
What do you mean in the pipeline? Contracts?
Contracts.
That sounds like a lot.
Yeah. Yeah. That's why, what future business look like? That's their future story. And did they have a down year in 2022? Looks like it. 2021, they did better than expected. And then 4.8 contracts are opening up, 65 million in pipeline. And there's no customer that's more than 25% of their business. Let's not get into the nitty gritty on this. This is what I'm just trying to show you is that there's bad deals. You're going to look at them and you have to dismiss those fast. There's good deals. that require more investigation and digging deeper. Like, why were you down in 2022, right? Why are you going up and down $1 million between those? Remember, 2023 is just an estimation when they created this SIM. So let's go back to this. This is what it would look like if you were to purchase a business with net income of $600,000. And I said 5%, that you're going to grow it a little bit. Some of it might be organic. Some of it might be through acquisition. But, 5% is not difficult if you amortize or cumulative growth over 5 years, and it average out to 5. Buyer salary of a net income $600,000 business, I said $175,000. It's not really high. If he took the owner being 83% and distributions, that's the net income after you pay your debt and pay everything else goes into the bank that you can use at your discretion because you own the business. 83% control and share. Salary and distributions could turn a $300,000 investment to, if you keep growing it over 5 years, to about $800,000 per year, or an ROI of 1,379. So in 5 years, let's say you got bored with it and you're now at 800,000 in net income, I'd give it a multiple expansion, maybe about a 1x. So you're now at a $1.8 million business is now a $2.4 million business. And this is without buying other companies. This is just organic growth. All right, so let's go to the next slide. We talked about deal flow, deal review, and deal financing. These are the three things that you have to have in place to climb that mountain, be prepared for, skills you need to be able to take that deal to the next place, which is investors or SBA lenders, and the attorneys or accountants or the insurance. You got to have a good deal there. Let's go. So here's just some testimonials you saw of somebody's purchased the course. James Shanahan, he bought the course and he's also done 27 acquisitions himself. He, loves it. Mike Brett is a friend of mine. He's an attorney and SEC attorney. We actually worked on some projects together. And Dave Rossler and Nicole. I don't know if you know Nicole. Nicole runs a business. She used to be a JP Morgan Treasury analyst or something. This is always going to lead to, if you want to come, let me help you do this. I've got to buy your first $1 million business. It's a course, but I also have a community. We meet every Monday, 11 a.m., and we play this pass or pursue. You bring a deal, we'll evaluate it, the SIM and or the financial report cards, and pass or pursue real quick and get some advice on it should you make an offer. Because you want to get really good at identifying good deals. That can only chase a good deal. You can only put financing together for a good deal. And SBA is not going to even look at you if you don't meet that 1.5 over 5 years. All right, so I'm going to open it up to questions.
Sure, this is Jose. How's everything in Tucson?
Yeah.
Good. All right. As you know, I'm in San Diego. My question is, you just mentioned about investors and so forth. Do you have like a template for a deck to present to prospective investors?
Yeah, hold on. Let me try to stop this share here. I don't know what I'm doing.
And by the way, your meetings are awesome on Mondays.
All right. Yeah. So my former life, I used to do create pitch decks and talk to a lot of investors on how to knock the doors. So we would create a pitch deck for you, and we have to create some kind of offer where they're going to see that they're going to get their money back, right? And the first they're going to look at is it a good cash flowing business? Can't get your money back from a business that's not throwing off cash flow, right? There's got to be enough ways for them to make money. And we create a pitch deck, and then you start casting a wide net, going out to investors. That's social media. Now, if you work with me, what I do is I get you on video and basically do a Shark Tank interview and put you on video. And I get that video out to my list, which is my email list, which is and also on LinkedIn, which is 21,000 followers, and then YouTubers and everybody else. And then you move them to kind of like through a funnel, and you just go, hey, look, here's the offer. You give a pitch. You try to convince them that you're a good steward of their money, and they're going to make their money back. And I just got to mention a couple of things. There's a lot of things happening today where there's two ways to get an investor on, right? They're either you're going to give them kind of some debt vehicle, which is a revenue share agreement. And those are really great for very profitable businesses. Like if I was to buy an accounting firm that's doing $2 million, traditionally accounting firms have a net income of 50%. So it's probably throwing off $1 million. I could give the investor a revenue share agreement, 10% off the top until the principal's paid. And if you want to give them a kicker, they'll, of equity, that's great too. Because you say, hey, here's my future story, which is I'm going to buy 2 more of these, get my net income to $5 million, and then package it up and sell it off to a private equity or a larger strategic firm. Or you'll see out like today, I don't know, everybody's familiar with Search Funder, is they're bringing this private equity venture capital model, which is participating preferred. It's an equity model, participating preferred, some kind of coupon, 8 to 12%, 1x liquidation preference, and usually a 2x step up, which is if they put $100,000 in now, 3 years, it's worth $200,000. And they're looking for kind of like a 30% IRR. That's the venture capital model. And I just caution you on heading that direction because it's hard to grow a business that fast. If you buy an HVAC company that's growing 5-10% a year, it's hard to give an investor a 33% IRR. So that's what I do. Who asked that? Was that Jose?
Yeah, Jose.
Yeah. So it depends on what the model looks like, and you got to figure out how to attract investors to make sure they get their money back in a certain period of time, and that you're a good steward of their money. You're a good operator. And that's what the pitch deck and the video does. Yeah.
In that example that you're going to be presenting an offer to here sometime this week, there was an SBA loan. And I know you're a veteran. You know I'm a veteran. Is there any special loans, SBA loans for veterans for purchasing businesses?
Not really.
No.
Or special coupons or points or, hey, it's 75% backed by the government. So it really just depends on who the operator is, their personal balance sheet, and the health of the business. And the SBA lenders buy box, right? Some SBA lenders like e-commerce, some SBA members do not, and they'll just do with service-based businesses that are 20 years old because they're in the business of getting paid back and they just want to minimize their risk.
So if you get an SBA loan and then you want to purchase another company within that industry, how difficult would that be? Well, is there a cap on how many?
It's $5 million. So if it's a $5 million business, you can't borrow from the SBA for another 10 years. But if you borrowed $2 million from the SBA in the first acquisition, a couple things happen here. One is you may not have to go back to the SBA because your balance sheet is so much stronger now. You can usually be the bank to purchase that business. Your business can. Does that make sense?
Yes.
Yeah. You may not have to go through that. And if you did go through that, usually SBA will see that as in line in the same industry and give you better terms.
Right. It's similar to the podcast you did with the owner of the plumbing company just recently. Yeah,
that too. And there was another interview I did with Brian Beers for Midas when he would go and buy. He already had like 20 franchises of Midas, and then then he'd go out and purchase another Midas, and he's the bank. He'd just offer 100% seller finance because his balance sheet is now, cash flowing 20 Midas franchises. So the key is right here is you got to pull your first one down. Get that first one. You are going to make mistakes. You're going to look under the hood. Like, has anybody ever rehabbed a house? You could look at the house and it's fantastic, or even watched one of those shows. And there's always something comes up that costs a little more, or you pay the ignorance tax or the stupidity tax.
Yep, that's right.
Yeah. You're going to make mistakes, and you're not going to see something, and you didn't mitigate the risk somehow, but just pull the first one down, because then it gets a lot easier. Who had the next question?
Oh, I have one more, if that's okay.
Yeah, go ahead, Jose. Then I got Mark Stillman. He's another
Okay.
student.
Do you require, or one of the criteria is to have cash on hand, like 3 or 4 months when you do your LOI, when you purchase a company?
Well, I mean, to pay your personal bills or to pay for work?
No, for the company, for operations.
Yeah, so that's a little more in-depth answer, because a lot of SMB sellers will want to take the cash out of the bank. They believe it's theirs, and they'll take it out. They'll drain it. But if you go bigger businesses, the cash in the bank stays on the balance sheet, because that's like the blood of your blood. You can't take 8 pints out of your body or you'll die. Now, what SBA will do is they'll say how much working capital is required. And they say, well, it's $100,000, right? It's total current assets minus total current liabilities, which is working capital. If it's $100,000, they're going to ask you to borrow $100,000 to put in the bank immediately when you close that loan. Does that answer the question, Jose?
Yes, sir. I appreciate it. Thank you.
Yeah. As an investor, Mark Stillman, as an investor, what kind of terms are typical? Did I answer that question when you're looking for equity investors, or revenue share agreement versus equity investors? Mark Stillman is on mute. Anybody else have a question?
You're on mute. You may have touched on that after I put in the question. I've had a couple of people call and ask me if I wanted to invest in different opportunities, and they were offering, we'll pay you back with interest within 6 months, which seemed a little quick to me, and we'll give you. They were offering to me what sounded a pretty good percentage of the company, and we'll run it for you and all that. I never did it, of course, because it seemed high risk to me. I wouldn't have any control of what's going on. And although I could do due diligence on the business that they're purchasing, how do you really do due diligence on the person running it?
Yeah. Well, yes to all of that. You got to do diligence on that. Like if somebody was to come to me and say, "Hey, John, I'm looking for $50,000. I'm going to go buy this company," and so, well, okay. Who is this guy that's asking me, right? Tell me about your story here, because I want to have confidence in you. I mean, that's what the SBA banks do. They say, I need a personal guarantee on this loan, meaning if the business goes south, I'm going to take all your assets. Ouch, right? I want to know. I'm not going to put a personal guarantee on the $50,000, but I want to know who that guy is and if I trust him with my money. And then I'll go, well, show me the business, right? If I knew this guy was a CPA for 20 years, and he's trying to buy a business and needs $50,000, and he's trying to buy this CPA business, and it's doing $2 million and throwing off 50%, I go, I know what he's offering to say, you're going to get cash on cash return in 6 months. I know that's possible. I can do the math.
Well, not only do they have to be capable, they also have to be honest.
Right.
The people that are calling me with these offers are just acquaintances.
Yeah, and I'll tell you this,
the business
there are
buying community.
scam artists is everywhere. I interviewed 2 people that said they did all this shit. Like, hey, I've acquired this many companies, or I did this. And both, and the last one, somebody called me after I threw up his episode and sent me an email and said, hey, you may want to read this. And it was an article about where the guy spent 7 years in jail for bust out schemes. I immediately took the episode down. So yes, buyer beware, those frauds are out there.
Jon, I just want to understand a little bit more about the initial package that you set up for when you want to buy a business. You've got lawyers, you've got accountants, you've got other people that's going to set it all up. That costs.
Yeah. So those do cost money, but you're not using those in the front end. You're not going to hire SMB lawyers out the bat and start paying them $500 or $1,000 a month. You don't need them yet because you haven't found a good deal. The key to finding is a good deal. If you find a great deal and you get it under LOI, there's a lot of momentum happens that they'll say, some of these, I'm not saying all of them, but they're going to go, well, I need some money up front. Or some others are going to say, great, I like you, I trust you, put the fee, you can pay me back when you settle.
Okay, yeah, got you.
And I'm not saying all of them are going to do that, because a lot of them goes, I don't know who Rudolph is. Has Rudolph ever gone bankrupt? Then they could do a UCC filing and find, yeah, he went bankrupt 3 times. Yeah, that's not going to happen. You pay me up front, Rudolph. All right. Let me get this question with Nick. How do you factor in working capital? Seems like the most owners think, like you just said, that is their money. If the business is saying $2 million, asking, would you, or they are not going to give you the working capital, would you offer less and get the rest of the finance through the bank? Seems to be a sticking. In fact, it is a sticking point. Because if you go higher up, the working capital stays in the business. But the SMBs are asset purchases, and you have to negotiate those carve-outs. You can say, look, I've done this 10 other times. Working capital stays in the business. Anything excess of that, yeah, go ahead. You earned it, you keep it. But some of them will go, I'm taking it out. And then you have to negotiate the working capital with SBA and say, hey, I need $100,000 for working capital. And they'll require it. They're not gonna give you a loan without working capital in the business, because it's the blood in your system. It's like taking 8 pints out. Nick, did that explain that? All right. Yeah, look, there's no easy answer to it. They shouldn't take the working capital out, but they do. And you just have to negotiate that, make sure you have working capital in the business. But it also does affect evaluation, because you have to ask the asset, wait a minute. Am I buying the cash? Is cash you pay dollar for dollar? Or are you taking the working capital out and reducing the price? You have to ask those questions to get to the right answer. Because
yeah, you can hear me now. It seems like that's kind of a sticking point. I'm talking to an owner, and it seems to seem like that's a you problem, not a me problem. Like, you figure out working capital. He's like, hey, that AR, that's all mine. So yeah. I think it's just like, if I want to stick to my guns, I'm not going to buy it. He's not going to let me sit and buy it from him. So yeah. So the AR is a different kind of beast or question.
True. Oh, like, what's the agent report? If it's not anything's on there 90 days out, there's probably about 50% chance of collecting it. If it's all stuff that he worked his ass off and it's going to be collected in 5 days, that's his.
Right.
Yeah.
Cool. Thank you. Appreciate it, Jon.
Yeah. And it's just like, it's better having these meetings and you sit on the same side of the table or in the same Zoom and work that out.
Yeah, it seems like he's an older owner, and it seems like that's just his mindset. Like, it's no matter how much I say, try to convince him, it doesn't matter. Like, if you want this deal, yeah, this is the price.
You got to take this the mid-market thoughts like, hey, working capital stays in the business, everything on the balance sheet stays in the business. Because that's not what every SMB seller feels. Like, I worked my ass off for that. That's mine.
Yeah. All these books tell you, hey, keep it in there. But when you get rubber to the road, the seller's like, no, it's not your money.
That's not your money. That's mine. So I want to make sure, is this valuation, is this working capital is not incorporated in the valuation, or is it?
Yeah, that answered it. Thanks. And also just going to the bank and knowing that you can do that. Would you go to the bank and I'm obviously they're not going to let you have it, especially an SBA loan, but would you rather do a line of credit as well with that? Or is it just they're going to give you enough working capital to support you?
Yeah, they're gonna put working capital in there to support you automatically.
Okay. Yeah. Thank you.
They're very accustomed to seeing sellers take out all the working capital. All right, so look, everybody, if you just go to dealflowsystem.net. If you want to join my community and be involved in play and pass or pursue, like understanding what it takes to find a good deal to take the next step. I'm happy to have you. So if there's any other questions or not, let's. I'm going to give it one more chance, and then we'll just kind of conclude. And this is recorded, so this will be going out. Jimmy Dumas, you're welcome. Thanks for the informative session. Tyrone Calvin's got a question. All right, how can you survive transitioning without working capital? You're not going to. You're going to have, the SBA is going to require working capital to be in the business. You can't pay for products. You can't pay for assets. You can't pay for people. Can't pay for anything without working capital in the business. So they're going to require, either it stays in, the seller understands that, or the SBA is going to require to put it in. Cool. All right, thanks, guys. You know how to reach me. I'm on LinkedIn, YouTube, or Facebook. You guys know how to reach out to me, or on Search Finder, or on email. All right, guys. Thanks very much.